going. I love it. Well, since we're talking about, group participation, how many of you have graduated high school? High school? Good. Awesome. That's the majority. Congratulations. It's that time of year. You're getting invites to different open houses from cousins and nieces and nephews. And the interesting part that I was thinking about this morning when I was talking about high school exit is really a lot of founders approach exiting their business in vastly different ways. And so you have some who can't wait to get out, just like many of you couldn't wait to get out of high school. You have some who are still kind of in high school. They're like living their high school fantasy, but they graduated maybe 25 years ago. And then you have a variety in between. Everyone's high school experience and exit from high school is different. And so this panel today, we're going to launch into exits from an investment and a founder perspective. So I'm so excited to introduce the panelists, and I'm going to let each of them introduce themselves. Scott?
Thanks. It's really good to be here. This is when I first started raising money in 2000 in Minnesota. I think we could have fit all the angel investors, at least the ones I found on this stage. I dragged a lot of people into it, kicking and screaming. And this is just an amazing event. So glad to be here. My background is mostly as an entrepreneur. I left when I left college. I had been an athlete more than an entrepreneur. And when I left, I was interested in business. Went to McKinsey, had a great experience in the office here. But it was also the dot-com boom. And that sort of pushed me into being an entrepreneur, and tried one business where I was the eighth hire. Did another one that was like an early software as a service business out in Colorado, and then came back here and started a business called Gov Delivery. I thought I'd get rich in a couple months at most. It didn't seem like it was going to take that long. I was there for 16 years. So from my 20s or mid 20s, I guess, to about 40. And then when we had a few exits, we can talk about that later. And then worked at a business called Structural, where we raised more aggressive VC money and exited after 6 years. And then for the last couple of years, I've been an investor at Mars and Power Venture Capital. Mars and Power is a large investment manager. Mars and Power Venture Capital, call it 70 million under management, compared to 12 billion for our parent. But we get to share the same snacks, which is good. And we have a team of 4. We invest in the upper Midwest with that regional sort of focus, but our real focus on the types of businesses. And it's tech-enabled businesses and technology businesses that are disrupting markets and industries, which is really what the upper Midwest we think does best. And I've been doing that for a couple of years. So entrepreneur and now investor. And I've done a lot of angel investing, probably 30 companies, and invested in a lot of funds over the years too.
Awesome. Katrina?
Can you hear me? There we go. I'm so grateful to be here. I think there are only 2 people in the world that ask me about this experience. It's Reed and Michaela. So thank you guys for asking me to be here, and for previous comedians. This is never an accident, so thank you. I get to represent the founders' experience as well. I started my journey in 2016, an idea for a platform while I was working at a health system here in Minnesota. And I had 2 co-founders that I met up with, and we said, okay, here's our dream. It's Airbnb meets clinical education, it's LinkedIn. Sometimes I'd say Tinder, but then people thought we were going to help you marry a doctor. And that was not at all what we meant by that. With the matching part. So we had this big dream that we were going to help future clinicians figure out how to get experience at hospitals, and then help hospitals be more strategic about how they might actually turn those learners into employees one day. So that was the dream. And I share that to say, of course, you're never like, what's my exit plan? You're like, I'm going to change the world, and we're going to help this system be all over the globe, and that's what we're about here. So as a founder, you're looking to get married to investors, not date them. And it's a very awkward first foray into it. But we successfully raised a couple rounds of angel funding, and we would not be here without the lifeblood of those angels trusting us, believing in our crazy ideas, and writing those first checks that felt like gold to us at the time, and still very much do. And then in 2019, we raised 1.5 million seed round, venture led, and then we had a great board meeting, January 2020, and then later it was sort of a wait, what do we do here? And I think there was a lot of wrestling that went on in that to say, well, what do we do? Are we going to exit? Or are we going to keep going? This is healthcare. Our buyers are hospitals. They're hemorrhaging cash. There's no end in sight. I also thought this would take 2 years to start a company and 2 weeks to have a pandemic. And I was wrong about both of those. And so we could have actually been more grateful that we had investors to guide us and help us think through that. They were very, very calm for us. Very, very excellent investor board members for us through that very tumultuous time. And we thought, I was kind of like, let's maybe get some strategic partners and really get this product distributed, because we found it was working really well. Our third client was the largest system in the country. We thought, this works, let's just distribute it. So the long and short is it turned into not a strategic partnership, but an acquisition by an organization called Sullivan Cotter, who had a really incredibly exciting, to us, the founding team, long-term corporate strategy. And we saw this as an opportunity to stay on. So presently, I'm the Senior Vice President of Strategic Growth at this, we call it the new Clinician Nexus. They loved our name so much. We started a new company together called that Clinician Nexus. So I'm the only person who can say I'm a two-time co-founder of 2 Clinician Nexuses in the whole world. And that's where I reside. So I'm working on what our long-term strategy is. What are we going to invest in over the next 3 to 5 years to meet the unmet needs of the health systems that we support, from education into practice for those clinicians. So it's a bit of things behind me.
Okay.
Good morning, everybody. My name is Pat and I am the managing partner of Arthur Ventures. At Arthur Ventures, we've been working hard over the last 12 years or so with the goal of building the most compelling early growth capital platform specifically built for B2B software companies. So that platform was really focused on partnering with companies like the $1 to $3 million revenue stage is our specialty. And we do it with a few different products. Our main product that many of you for us probably think this more in the slides is a minority equity investment strategy. We're currently investing out of our 6th fund for that strategy, which is $395 million. It started as a $45 million fund back in 2013 and has scaled nicely over the last 12 years or so. We also have a growth fund strategy, which is built really for existing portfolio companies. We're investing over our 5th growth fund, which is $205 million. And that's really meant to be like mid-stage expansion capital for companies. And then we also have a small control fund, so like an actual buyout fund, which we just closed our first vintage of that fund at 200. So current fund family is like an $800 million fund family across those 3 products. And we're based in Minneapolis, and we're a team of 12. So happy to be part of the ecosystem.
Thank you. So, Pat, I'll actually have this first question to you first. Investors don't often make a return without an exit. So when you're investing, how much are you actually thinking about an exit?
Yeah, it's pretty core to the entry. And there's so much unknown, right? So it's really hard to make an investment, feel like you know exactly how it's going to unfold. So we think about it in 2 ways. And I'll preface this with saying, we're a firm with institutional limited partners, or we kind of have to do this. As an angel investor, you probably want to do this, but you certainly not required. For us, we will not make an investment. It's like our investment objective where we enter, and I'm going to get pretty specific here, is we will not invest in a company if we don't think we can make 6 to 8 times our money on that investment, selling the company for 7 times revenue. So that's for us, okay? We invest in much higher multiples of revenue for that. So we have to build a model that basically shows if we invest at a high price, because early stage investing is just fundamentally expensive, do we think this business can get big enough whereby if we have a more rational outcome down the road, can we meet our investment objective? So we will go through that exercise every time, but what I actually think is more impactful thinking about the exit is in our annual meeting, which we do once a year, we have all our investors come in. It's pretty boring. If any of you guys aren't fun, sometimes it can feel like a big marketing commercial of all these amazing things we're doing. And ours is pretty dry. We literally just put up a model for every single fund that we have by company with assumptions on what we think is going to happen and how the company is going to exit. The reason that's so important is because the model is always wrong. But what it's done for us is it's allowed us to be honest with ourselves on what is the potential of each investment that we've made. What's our price for that company? So when these exit options come up, which they come up, quickly and sometimes randomly, how do we think about that price? How does it match to what we think that company is capable of? So we think about it really all the time. And we always call it just make sure you're underwriting your own book. So during the whole of the investment, again, you are informed and you have an opinion. So when that opportunity comes up, you can actually make the smart decision and not just feel like you have to kind of, shoot from the hip for lack of a decision.
Yeah, discipline is so important. Scott, how about you?
I like the idea, and everything that's starting with the end in mind. And I think, like Patrick, we're paid very specifically to give people back more money than they gave us. And so we really do focus a lot on what is the exit potential of something. I think that what varies for us is the earlier you come into an investment, this is true of angel investors too. I think that there's so much more risk in whether the business is going to get some velocity out of the gate, that there's probably more work to be done on that the earlier you are than on the exit. And that's become more true over the last 10 plus years as the sort of PE market has really matured. There's a lot more exit options out there. So if you're investing in recurring revenue technology businesses, if they're successful, there will be exit opportunities. It used to almost be, would anyone buy this? That's not close to true anymore. And so I think the good news is, as an angel, you don't have to worry too much about whether something might be marketable. For us, we are trying to put some bookends. We do an investment on what we think the exit potential of it is. And so that process for us is we sort of come at it from what's the least success this business would have to deliver the kinds of returns we're looking for. It depends on the deal for us, but it's a similar range to what Patrick described of the returns we want. And then what is the sort of upside scenario and how far can this go? And we are willing to look at businesses that are in smaller niche markets that aren't necessarily in these monster healthcare markets or other competitive markets. We have a business that does airplane part tracking. In that case, we're a little more sensitive on the valuation because the market's not as giant as maybe a healthcare market might be. In other cases, we look at it and say, gosh, this business is competing in a highly competitive market. That bookend process comes out pretty well for us. And then it really becomes, how are they going to do against all of the other people in the market that are seeing the same thing we're seeing? The very attractive markets attract very adept competitors. And then we often ask the question, what would it mean to be the winner versus another player in this market? Is there room for multiple successful players? So that's our process. I think it's not that hard to model, actually. We do the model on the back of an envelope initially. And it's like, what kind of, we invest in a little more variety of companies than Patrick, but it's often B2B SaaS or some type of B2B product. What's the multiple that this business might have at 10 million or 20 million in revenue? And we have a basic range we can estimate. Patrick just gave you what he uses. There's some variation in our companies, so we'll go spot check that with private equity firms typically and say, what might you pay for this? What might you look at? And if we have a potential acquirer in mind, we'll try to get to them and see if we can poke around about what they pay. And then the rest of it is the financial model of what we really believe can happen with the business to get into that range. And that initial process, like I said, it's back to the envelope. It's fifth grade math. It's really not that complicated, but validating the assumptions around it and then mapping that to the potential of the business can be a little more complicated. And I think as an angel, the good news is coming in early, lower valuation. And there's so many different ways the company you're investing in can fail that thinking 10 years ahead of what the exit might look like might not be as necessary as just thinking, can they hit some velocity in years 0 through 3, while also understanding that you want to align with an entrepreneur who understands that once they take your money, they are going to need to get to that exit eventually.
So in terms of, the different scenarios we could play out in terms of exits, not every exit is going to end up with you ringing the bell on Wall Street, doing an IPO. So what are the different scenarios and some trends that you're seeing? Patrick, I'll start with you.
I think the biggest change that we've observed over the last 5 years or so is the strength and quality of the private equity ecosystem. Every company has the financial attributes that is attractive to that ecosystem, mainly capital efficient growth is really core. We've allowed private equity firms to pay higher prices and move incredibly faster than strategic. So when I first got started with this business, it was always, I got to wait around for Microsoft, Google, whatever to come in and we're going to get it. Right now, we've had 2 scenarios in the last year where we've actually chosen a financial buyer at a lower price than a strategic because we thought there was greater deal certainty. Like legitimately, like one of them got done, signed and closed in 16 days. And it's because these places are machines. Their ability to pay is incredible and they have a massive amount of money. And so I just think that's probably the biggest shift that we've seen is just that market has come in an incredible manner. And if you continue to look forward, which I know we'll talk about in a little bit, there's just so many secondary market buyers right now with our private equity firms that are trying to come in and buy out angel investors. So the good news for everyone in the room is that I believe the exit paths, assuming the company is quality and is capital efficient, feels like it is multiples higher than what it was when I started.
So, and Scott, do you have any additional thoughts you'd like to add to that?
Well, I think that summarizes the best news. That makes angel investing so much more practical. It's much, much less complicated to find exits than I think it was 10 years ago or more. And that's continued to progress in that way. There's a lot of other types of exits, like you mentioned, but I think that, you all with your companies, it used to be everyone was going to do an IPO or sell to Yahoo. That was sort of first one we were talking about tech or sell to Microsoft or whatever. Companies might have an idea of who they're thinking about, but as they evolve from the stage you're investing at as an angel to later, the PE path is sort of always pathway now, I think, almost always. It can be modeled, it can be looked at, and people are easy to get in touch with, and they want to build relationships with you. In fact, some entrepreneurs could blow their whole year of being PE firms once they get to some level of scale. They'll hear similar things from all of them because the market's pretty consistent. The other type of buyer, the strategics that still I think are really compelling is when the company is worth more to them than it is to the seller. And I have been involved in a couple of these sales where a relatively low revenue company, I've bought a few firms when I was building Gut Delivery up, which was a digital marketing platform. We'd buy a company it was doing $300K in revenue. We might pay $1 million or $2 million, which is a pretty big price for that revenue because we knew the second we bought it, we could get $500,000 of sales immediately. And if that situation exists for companies, that's when the strategics make a lot of sense. We sold Structural, my last company, to a partner, and there's just no question that the company was worth a lot more to them than it was to us or to any buyer or any PE at the time. So that's worth thinking about. And then there's a whole bunch of other scenarios which are things didn't work out perfectly, but we have to do something with this company and try to get some money out of it or keep people's jobs. And those are reasonable scenarios you will run into if you do enough angel investing. And I think that as an angel, it's often just kind of cheering people on, trying to help, be supportive, let the company move whatever route they need to move to try to find a landing spot. Some of those can end up being more X's, and sometimes you just there's a lot of exits posted on Twitter where the founder got nothing, the investors got nothing, but the job kept and the product got to live on, and that is normal. That happens. That'll happen with a portion of a decent angel portfolio for sure.
So, Katrina, I'd like to move to your perspective as a founder. How did you set up kind of win-win situations where both the founder and the investors were aligned?
I would love to say I did an absolutely elegant job at this, but I did not. I was learning as I went. And I think if I could do over, I'd make it less about the terms and more about the people involved in the conversation, especially in angel investing. When you get in at that stage, it's still some high risk, high concept. And your lifeblood is energy from your team to believe in what you're doing, some cash to live another day, and then also invitations to meet more people that could buy or invest or support whatever you're building at the time. And so I think, you know, I was not that methodical about. I was like, oh, 10 years from now, 5 years from now, yes, I thought about maybe we'd get big or we'd exit, but I wasn't plotting to that because I don't think that's what that's an outcome, not a cause to get into that end. So maybe spending more time on people, why they're investing, why you want money, how you see this going, and also I think it would have been nice for us to think a little bit more about how might your investment change over the period of time when we have other planned rounds where we'll start stacking other investors that might take preferences over your investment, and what will that do over that? And so I think there's just a lot of diligence. Kind of to your point, it's very different. This community is very different than when I was raising capital, and it was sort of a known thing. The founder community actually kind of collected themselves together to say, let's build a list of these angels who are wasting our time, because I just quit my job and I can't feed myself, and I don't have time to talk to an angel investor 15 times because it's fun for them. I need to get serious with me and write a check or say no. And that actually, sometimes that can be hard. And that might have been hard to say to me. So people think I'm a nice person. I'm like, I don't know, I can take the hard truths and say no to me. I'll cry in private maybe, but it's fine. But it's actually more beneficial to be told no and why more quickly as an angel. Because I'm excited to soon join the angel investing community on the other side. And I think the one thing I'm going to make sure I do to support the founders is not waste your time. Because again, that's one of the highest values to you. So I think that's a bit of it. And then sometimes you don't know what you don't know. I learned the hard way with some of our agents that they wanted to be far more involved in it than we did. And it took me a while to realize that despite my deep desires to not be human and be as methodical and perfect in my decision making, I'm still influenced by the people I'm surrounded by. And so when you're building an angel network or you're building that first advisory board that maybe plays an angel role too, those people get in your head as a founder. And I think it's a responsibility on both sides to remember we're getting into a business relationship together, and the whole self of both parties matters greatly. So I think that's the harder, messy work. The terms easy. That's the easy part.
So from an ownership standpoint, as the company is maturing into a larger, more capitalized company, is there anything investors or founders can do? Scott, and I'll start with you, to kind of set themselves up for success as the company scales.
From an exit standpoint,
Sure.
angel investors, it's definitely in my most successful angel investments, it becomes a spectator sport at a certain point. So I think it's surprising sometimes to the angel investors, especially companies that go on to raise more capital and institutional capital. The angels can maintain a relationship with the founder, and they might be tapped out for advisory stuff from time to time. But honestly, the best deals I've done as an angel, I had as much contact with them as I do with the Timberwolves. Very little. But I could go to the games. They had updates sometimes. There was other stuff. But they just didn't have a ton of time for me. You're $50,000 on a cap table that might have raised $100 million of that. I'm not a key principal in that business. I think from an angel investor standpoint, there's not as much you can do there. If you're in some kind of advisory role, you're working with the founder, I think just recognizing to kind of be responsive when you're needed and help them understand where you really can be useful. Some angels are really good as sort of counselors. Some are good as moral support and cheerleaders. Some have very specific industry expertise. Make sure the entrepreneur knows when to tap into and when you want to be tapped into. And I think that's probably as much as you from an angel standpoint. From our standpoint, and from a standpoint of a more significant investor, because I've experienced PEs owning part of my company and and VCs owning part of my company, they're always moving. The good ones do what Patrick's saying. You know, they're underwriting it all the time. They have an opinion, they have a view, they're thinking about the levers you can pull, all of those things. And they're hopefully helping guide the entrepreneur who may be doing it for the first, second, or third time compared to, you know, Patrick, who's living in this kind of transaction world all the time, hopefully helping the entrepreneur triangulate when they should do it, how they should spend time. For me, because we were looking at both PEs and strategics with Young Delivery, which is the company I ran that got to more significant scale, I tried to just allocate a portion of my time to meeting with the PE firms I wanted to sell to versus just dealing with the inbound calls. And that's sort of just an overall philosophy I have. The world responds better to you if you come at it instead of let it come at you. And so I tried to come at the PEs I thought would be the best. And we ultimately sold to one of those twice. We sold once, and the second PE sold to another group we liked. And then the strategics, it's a little trickier. It's a little bit of a dance, but I tried and probably could have done a better job of forming relationships over time. You can't, as an entrepreneur leader, sink too much time into the things that are about selling the business versus building the business, because the best way to sell your business is to have the business be highly successful. And so the other stuff's just got to be a contained activity. That's how I thought about it.
Pat, what are, looking ahead 5 to 7 years, what type of exits do you see happening more and more? And how can angel investors specifically prepare for that shift in the next investment?
Yeah, I would just add on to what I said earlier on. I think less frequent are the days of one exit for all parties, right? So if you're kind of like, hey, I'm going to make an angel investment and then I'm going to sell when 100% of the cap table sells because some strategic came in and bought it, I just think those days are few and far between. And I just think it's going to be much more multiple bites of liquidity because there are more successive financing rounds. So if I were an angel investor and I had a company that was raising capital, maybe not the first round after I invest, but maybe the second round or the third round, I would always be thinking about, is this an opportunity for me to sell? Because so many people are providing liquidity. And so I would really think about it that way, because otherwise you can get a situation where, you're really, really waiting around, kind of expecting some big outcome, and you maybe have missed, some intermediate opportunities to achieve liquidity. And there's just so much partial liquidity going on in the market. I think it's going to get even more substantial because there are a lot of funds that are now specifically just raised to do this, right? It used to be like, from like a just invest in the company and maybe we put in $6 million to the company, we can allocate $2 million to buy shares. There are really funds that just come and try to buy each shares. And so I just think that there's going to be a lot more opportunities than anything else.
That's very true. I mean, you see so many fintech firms trying to create those liquidity events for the private markets that have been historically your financial advisor is going to be like, oh, that's an illiquid market. Well, it's changing very dynamically. So Katrina, I'll pivot a little bit to you. What are the signals, or what were the signals for you telling you it was the right time to sell?
Great question. The pandemic. That's like the big obvious one. I feel very grateful actually that we made the choice to exit. We didn't have an offer for additional funding to keep going. So I feel very privileged to not have had what could have been perceived or might have felt like an exit because of the pandemic. We made a very strategic choice, and I think this is probably the founder and my husband has gone through a cancer journey, and I've been up close to the healthcare system in a way that I was like, I can't take advantage of it right now. Money's great, but I don't have the heart to say, all right, let's pile in a bunch of capital and go take it from them when they get money. And that just didn't sit with me. So there was a bit of that. You have to read the market, the buyers, and we could have pivoted, could have sold the large, payers or tried to do something different. But again, I think we were feeling like what we have is valuable, and we actually did a diligence process with our board to say, what do we have that's an asset that becomes extremely valuable? Let's put a partnership thesis together, and let's go out and find a partner to distribute this alongside the community. I think a bit of it's, you have to read your industry, your market, and ours, we knew it's relationship and trust based. So we're not going to get a bunch of capital into a marketing campaign and go nuts. We're going to go get with someone who already knows our buyers, and we can come alongside and say, we know for a fact you're going to have a installation shortage. Why don't we partner and make sure that we mitigate that together, because we have a pipeline coming into that. And so there's a bit of that. I'd say capital was there, so that wasn't an issue. Our team was tired a little bit at that point. And I think part of it was, we were on a high. We had a really fantastic startup story, dreamy first time. My co-founder said we caught a whale with the kiddie pole we were fishing with in March. And it really was a blast. It could be a case study, really, of, there's no reason why this whole system should have trusted us 20-year-olds to do what we did, but we did, and they're our biggest client, biggest cheerleader today. But I think there was a bit of exhaustion from the team. So I think that there's a bit of that. Be it, one hire that didn't go well, that kind of drained the team, and the pandemic was scary. So there's some of those sides to it as well. And then I think it's just, again, who's surrounding you. I think somebody gave me the great advice on healthcare: do not raise capital from a venture capitalist fund that has 20% or less of a healthcare thesis, or else they won't know what to do in a hard time. And actually, in 2019, when we were raising, everyone from the .com group was warning all of the early, the new founders of me, don't go for high valuations, don't do that. It's not all perfect. I don't know if you guys recall, 2018 felt like there was no ceiling to a lot of things, valuations, a lot of growth potential. And so we kind of hit that. And there were a couple investors, you can tell they were like, I was excited about healthcare, but I don't feel like we have enough intelligence to really take us through this. And so, again, it's just all about who you surround yourself with, relationships in there. And then, again, hospitals were not looking to buy our software. They were trying to figure out how to stay open, manage patients running around their hospitals. So, just a casualty of that. I think our story would be so different without a pandemic. And I grieved that. That's been, and I've been hiding grieving that for the last few years. But at the same time, I am really excited about who we've joined up with now. And I think we're going to have a better long 10 to 20-year impact on our industry instead of that. Also, I will say our angel investors had a good return. So that was a good time for them. I don't know if our VCs loved it, but our angels did well. And I think we took that time to look at, if we could start stacking more players on this, that's who gets diluted, is the founding team and the angels. And if the founding team is tired, good luck. So there's a lot, it kind of felt like, all right, all signs point to, let's get refueled up with another group here. So
Scott, I'd like to hear from you on that too. When did you know it was the right time to sell?
I think it's super personal for each company. And in an ideal way, in an ideal situation, you're doing well. There's some alignment with the key people on the board and the shareholders and the founders and the executive team. There's some alignment about maybe thinking about an exit. And you also have some visibility to future success that you can sort of demonstrate. The PEs especially, it just makes it a lot easier. You get through a process very fast. And that's ideal. It's very common. It's actually, I think, more common in this market for some reason, that people get really excited about their company and the founder's really passionate. And then they wait until the trouble. And then they start thinking about sale. That's the worst case scenario. Pandemics happen, things happen, and other things happen, but that's not ideal. Even better is if your company is doing really well, you're not really actively looking to sell, but a buyer comes at you and it's appealing and you have some sense of what the value is of the business. And you say, this is what happened to us. A buyer came in, they said, we think we'd pay this. And I was like, wow, that's more than I thought anyone would pay. So let me go talk to my board about it. Went and talked to the board. The board was like, first of all, said, well, we're not for sale. We're not going to do it. It's bad timing. And then I set the number and they were like, you know what? Let's have a call. And then we had the call and we actually ended up then getting like, wow, you get sort of greedy. And we hired an investment bank who went out and got like 30 million more on the deal. And so that was a very good scenario. We were roaring. It was the best streak we'd had in growth. And the market was just really excited about what we were doing. And that just to our benefit, I was in a company called Gut Delivery. There was a company called Granicus we tried to buy before that was a little smaller. That company went on the market at the same time. And so a couple Bs chased it, one bought it, and they literally called me and said, we're either buying you or we're going to retrade that business in 60 days, sell it back. And I was like, wow, you're really locked in that. That's good. And we sort of raced to the finish line. The Trump election looked imminent to me, which, you can ask me about who's going to be our future presidents if you want. This is 2016. And I was like, that's going to be a rough patch for us, which it was in the end for the business. They worked through it. And so we got very excited and we picked the buyer with the slightly lower price who was moving fast enough to beat the election. and they did. The second the election happened, the partner on the deal, who I didn't think had tear ducts, called me, and he was clearly slightly crying on the other end of the phone. So they worked through it and got a great return. But, you just start playing this moment, and it's very intense. And up until that whole series of events happened, I was like, I had a plan for 3 years. We weren't going to think of selling. So that's just one example of how opportunistic it ends up being.
Yeah. But what you said alludes to forethought, right? And in the lower middle market where I invest in manufacturing, distribution, and much slower, paced businesses in that respect. You have the stories where they didn't plan. This past spring, I spoke to a woman who 3 years ago, her manufacturing company was worth $70 million. She and her husband ran it together and they were going to the moon. Well, he was in charge of sales and marketing. They had no clear succession plan, no plan to sell anytime soon. He got pancreatic cancer. And within a matter of months, she was running the business by herself. Well, grief-stricken with no plan, she rejected 3 very viable offers to sell. By the time I had spoken with her, she was auctioning off her assets for $5 million. So when you don't plan, in the world I work in a little bit more so than with young founders who might, be tired, right? I understand that. But there's loss of not only that person's, family wealth that she could have passed down, but the employees all lost their job. You have a loss of the economy around that business, right? And so you have, in the case where you're not preparing, you have the worst case can come up so often. So I, applaud you in terms of thinking with the end in mind, because I think it is a very economically forward way of running your business.
I'll just add, entrepreneurs who haven't done it before and angels who haven't done it before too, I'll take that, don't understand how hard it is to get exits. It's gotten a lot, in a positive way, for all the reasons Patrick outlined really carefully. It's gotten a lot easier to get money out. Way easier. But like that clean exit where somebody buys the company, and it can be hard to get there. And I think when I'm coaching entrepreneurs, at least, I think that any offer is worth sitting down with and looking at it, taking seriously if it's a decent offer, because pandemics happen, things change, people get sick, divorces happen, clients get lost, and you never know what that bird in hand is going to look like later when you can't find any interest. So I think, encouraging, if you're working with entrepreneurs, encouraging them to be open to at least thinking about it as an exercise, I think is really important. Because it might not be next week that the next offer comes in. It could be 10 years.
Yeah, absolutely. So in the 1 minute we have left, any final thoughts? And Pat, I'll start with you.
No, I think assuming that most people in the audience do have active angel investors or evaluating, I just think it's a phenomenal time to be active in the ecosystem. I think we belabor the point on just like how amazing it is in terms of the amount of exit opportunities that are available. But if you can be thoughtful about portfolio construction, be active in a community, and be thoughtful about exits, I really do think it can be fulfilling. And I think Scott made a joke about you could fit the amount of angels on this stage. Having been in the ecosystem for like 12 years, it is probably the strongest I've ever seen it in terms of like things like this did not exist when we got started. So thanks to Group and for putting this together, for being here.
Katrina, final thoughts?
I was just thinking, and I did hear all afternoon if anyone wants to keep talking about it. Honored to represent the founder's perspective in this. There's 13 seconds. You want.
I will echo the thanks and just say that angel investing has been a really great asset class for me, and I think it's going to keep getting better. And I think for that reason, it is good timing to be doing it. The tax situation is really great, and it is the very, very best way to put money back, in my mind, into our local economy in a way that you can contribute to the local economy and make hopefully an above market return. So thanks for doing it. And I hope you have as good a luck with it or better than I've had.
Thank you, everyone. That's our panel today.